Dear learners, I welcome you all in this session on final accounts. Well, friends, we were discussing about the adjustments while preparing the financial statements. So, we will now see what will be the impact of adjustments on the financial statements. So, the next adjustment pertains to the interest on drawings. So, when the proprietor withdrew some amount of goods or cash from the business for his personal use is called drawings. So, the drawing may be in the form of goods, drawing may be in the form of cash. So, when the goods or cash is withdrawn by the proprietor for his personal use is known as drawing. So, it is an income for the business and is charged to the profit and loss account while preparing the final accounts of the firm. Like when the business is providing the interest on the capital contributed by the proprietor in the business and is treated as an expense for the business. In the same way, interest on drawing is an income for the business, because when the proprietor withdraw some amount of goods or cash from the business for his personal use, then the business will charge the interest on the drawing. So, this interest on the drawing is an income for the business and is credited to the profit and loss account while preparing the financial statements. Since this information is provided outside the trial balance and it is provided as an additional information, therefore, it will have an impact over the financial statements minimum at two places. So, the first is that interest on drawing being an income for the business is shown in the credit side of profit and loss account, and then this interest on drawing. So, here when it is an income for the business, interest on drawing will also be added to the amount of drawing, and amount of drawing after addition will be subtracted from the capital, and after subtraction the net amount is shown in the liability side of the balance sheet. So, this is how the interest on drawing is charged. So, interest on drawing is just a reverse to the interest on capital. Next, here when we say interest on drawing, so the journal entry for this adjustment would be capital account debit or drawings account debit to interest on drawing, because here if we will debit the drawing account, it will automatically enhance the amount of the drawing, and when the amount of the drawing is enhanced, it will automatically reduce the amount of capital of the proprietor in the business. Or directly we can debit the capital account, so it will reduce the amount of the capital, because capital is a personal account, and capital is a personal account, and it is shown in the liability side of the balance sheets. So, capital is a personal account, it has a credit balance. So, when we debit the capital account, it means that the amount of the capital is reduced by the same amount, and interest on drawing, since it is an income for the business, therefore, as per the rationale of the nominal accounts, any income and gains is to be credited. Interest on loan. If the firm has taken some loan, it has to pay interest thereon. Hence, when we notice a loan account in the trial balance, we must find out whether the full amount of loan has been paid or not. The rate of interest and the date on which the loan has been taken is usually provided in the trial balance. If, however, the date on which the loan has been taken is not given, it is assumed that this loan belongs to the previous year. It means the loan has been taken in the last year, and now in the current year the full amount of interest on the loan will be charged. Generally, we find that the interest has been paid, but it is less than what it dues. In such a situation, the difference is regarded as outstanding interest. Dear learners, we will discuss and we will try to understand this concept. This is what we call implied interest also, with the help of an example, and I am sure that when we will discuss it with the help of the example, we will take an hypothetical situation, and then with the help of that we will discuss how this implied interest is shown while preparing the financial statement of the business. Suppose there is an item of 10% loan taken on 1st April 2018 of rupees 20,000 appearing in the trial balance. So here all the relevant information have been provided, assuming the accounting year ending on 31st of December. The total interest on loan work out as rupees 1500. So here the loan has been taken on 1st of April 2018 and the financial year ends on 31st of December. It means the financial year starts from 1st of January and comes to an end on 31st of December. This is the period of 12 months. So here, since we have taken a loan on 1st of April 2018, therefore the loan has been taken after 3 months. So therefore, in the current financial year, we will provide the interest on loan for 9 months, which works out to be 1500 rupees at the rate of 10% on the amount of rupees 20,000. On going through the trial balance, we find that the interest paid is rupees 1000. It means that the interest of rupees 500 is the outstanding interest, because for the current financial year the amount of interest on loan comes out to be 1500 rupees as we have worked out just now. So out of 1500 only 1000 has been paid. So therefore it shows that rupees 500 is outstanding. Therefore we need to pay rupees 500 as interest on loan. So now how we will treat it while preparing the financial statement? So it's as simple as we have discussed in the previous lecture. So here, while preparing the trading profit and loss account, the amount of rupees 500 as outstanding interest, so it will be charged from the debit side of profit and loss account. So in the debit side of profit and loss account, total amount of rupees 1500, that is interest paid rupees 1000 plus outstanding interest rupees 500. So here total 1500 rupees will be debited to the profit and loss account, and while preparing the balance sheet we need to show rupees 500 as outstanding interest in the liabilities side of the balance sheet under the head of current liabilities. because this amount of rupees 500 is yet to be paid. By the end of the financial year, this amount of rupees 500 on interest on loan is outstanding. It has not been paid yet. Therefore, if any expenditure we have incurred during the financial year and has not been met so far is called as outstanding liabilities. So this interest of rupees 500 on interest on loan which has not been paid yet by the end of the financial year will be treated as liabilities, and it will be shown in the liabilities side under the head current liabilities. Bad debts. Well friends, bad debts, you might be well aware about this item, bad debts. It means any debt which has become bad, any amount which we could not recover from our debtor is known as bad debts. Well friends, you all might be knowing that in the competitive world, in order to sustain in the competitive business environment, we need to extend the credit facilities to our customer in order to make more and more sales, and when more and more sales is taking place, more and more profit will also takes place. So here, when in order to earn more and more profit, when we extend the credit facilities, when we make the sales of goods on credit terms and conditions to our customer, so when any amount which is due from the customer side is not being recovered by the business is called bad debts. And it is quite possible also that when we extend the credit facilities to the customer in order to make more and more sale, a part of this credit facility, a part of this amount will not be recovered from the debtors. Debtors are the person to whom we have sold the goods on credit basis. So the adjustment and the treatment of bad debts is very simple, because bad debts is a loss for the business. This is the amount which we could not recover from our customer. So being the loss for the business, the amount of bad debts will be shown in the debit side of profit and loss account. Since the amount of bad debts is shown in the adjustments or outside the trial balance, therefore it must have its impact on minimum at two stages. So first is the bad debts will be shown in the debit side of profit and loss account, and the another adjustment of this item would be the amount of bad debts will also be deducted from the amount of debtors in the asset side of the balance sheet. This is how the amount of bad debts is treated while preparing the financial statement of the business. So as far as the journal entry of this transaction is concerned, it's quite simple, because bad debts is a loss for the business, and being a loss, it is covered under nominal account, and when we apply the rationale of the nominal account, debit all losses and expenses. So being a loss for the business, it must be debited, and the debtor account is a personal account. So as per the rationale of the personal account, the account of debtor needs to be credited. So the journal transaction would be bad debts account debit to debtor. Then the next one is provision for bad debts. So this is slightly complicated, but I will try to make it as simple as the provision of bad debts. So just try to understand and try to focus on this point what here I am going to explain as far as the provision for bad debts is concerned. And yes, of course, this adjustment pertaining to the provision for bad debts, I will try to explain it with the help of an hypothetical example which will make you more clear. So in any business where goods are sold on credit, bad debts usually occur. Yes, of course, when we extend the credit facilities to our customer, so there may be a chance of bad debts. When it is certain that a debt will not be recovered, the amount is written off as bad debts. But it is also likely that some of the remaining debts may not be recovered in full. So from the experience, we know that certain percentage of amount due from debtors may not be recovered. This will be a loss to the business. According to the conservatism concept, we must provide for future losses but not for the future profit. Hence, it is a common practice to make a suitable provision for doubtful debts at the time of preparing the final accounts. So here I would like to advise to my learners that provision for doubtful debt is always made on the fresh amount of the debtors. So it means after subtracting the amount of bad debts from the amount of debtor, then the provision for bad debts will be provided. So this the students must always remember. Otherwise, the profit and loss account will not reveal the correct amount of profit or loss, and the balance sheet will not show the true position of the debtors. The provision for doubtful debt is usually calculated as a certain percentage of the total amount due from the debtors after writing off all non-bad debts. The provision is made by debiting the amount of doubtful debts to the profit and loss account. Thus, the journal entry for creating such provision will be profit and loss account debit to provision for bad and doubtful debts. Since the provision for bad and doubtful debts, again it is a loss for the business, and any loss for the business is always charged from profit and loss account. We notice that when a debt is irrecoverable, or when the debt is not recoverable, it is written off by crediting it to the personal accounts of the respective customer. But when a debt is doubtful of recovery, the personal account of the customer will not be credited, because we cannot credit the account of the customer unless the amount has gone to bad debts. So when there is a chance of bad debts, so being the chance of doubtful debts, the account of the debtor cannot be credited. So if we credited the account of the debtor, it means the amount has gone into bad debts. So that mistake we should never commit while dealing the adjustment of provision for bad and doubtful debts. Hence, the creation of provision for bad debts does not affect the balance of the debtor personal account. However, while showing the amount of debtors in the balance sheet, the amount of such provision is subtracted therefrom. So here we should be very clear that while making the provision for bad and doubtful debts, we must be very clear that this provision is made of a certain percentage on the amount of fresh debtor. So fresh debtors means if any amount of bad debts is given in the adjustments, which is called as further bad debts, will be deducted first from the amount of the debtor, and then on the fresh amount of debtor the provision for doubtful debts will be created. Let us see how it will be created, how it will be dealt when it is given outside the trial balance. So when provision for bad debts already exists in the books, the provision created for doubtful debts at the end of a particular year will be carried forward to the next year, and it will be used for meeting the loss due to bad debts incurred during the next year. So if there is any balance of provision for bad and doubtful debts is given in the questions, this balance will be carried forward to the next year, and if any bad debts takes place during the current year, so that amount of bad debts will first be charged from the amount of provision for bad and doubtful debts. The provision for bad debts brought forward from the previous year is called opening provisions, or we can call it old provision for bad and doubtful debts. When such provision already exists, loss due to bad debts during the current year will be adjusted against the same. It means if any balance of provision for doubtful debts is given in the trial balance, so any loss due to bad debts, if takes place during the current financial year, that loss will be met out first from this old provision which is given in the trial balance. Making provision for bad debts required at the end of the year is called new provision. So balance of old provision should also be taken into account. Let us understand it with the help of an example. Suppose old provision on 1st January 2018 was rupees 1000. So this balance of provision for doubtful debts is given in the trial balance in the credit side of profit, in the credit side of trial balance rupees 1000. Bad debts written off during the year 2018 rupees 600, and the new provision required on 31st December 2018 is rupees 1500. So in such a situation, the profit and loss account will be debited with rupees 1100. Now just try to understand how did we arrived at rupees 1100 as far as the provision for doubtful debts is concerned. So for this, it is very simple that you keep an equation in your mind while making a provision for bad and doubtful debts as far as the amount which need to be charged from the profit and loss account, and the equation is bad debts plus further bad debts plus new provision minus old provision. This is the equation. So just I repeat it again. The equation is bad debts plus further bad debts plus new provision minus old provision. So the net result of this equation will be charged from the profit and loss account. Now I would like to make this equation more clear. I would like to elaborate this equation, bad debts. First of all, bad debts. So this bad debts is the amount of bad debts given in the trial balance plus further bad debts. Further bad debts, the amount of bad debts which is given as an additional information outside the trial balance, plus new provision which we have to make on fresh debtors. It means after subtracting the amount of further bad debts from the amount of debtor given in the trial balance, we need to make a provision on the debtors minus old provision. So, old provision is given in the trial balance. So, here we will simply apply this equation on the information provided to us, bad debts. So, here bad debts, the amount of, suppose the old provision on January 1st 2018 was rupees 1000, old provision. Bad debts written off during the year 600 rupees, bad debts 1000, and here new provision is required to be made, it is rupees 1500 minus old provision. So, old provision is rupees 1000, new provision is it is 1500. So, this amount of bad debts, the amount of bad debts in the trial balance is not given. So, it is 0 bad debts plus further bad debts. So, further bad debts is 600 which has been provided outside the trial balance. So, bad debts plus further bad debts plus new provision is 1500. So, total it is 2100 minus old provision. So, old provision is given, it is 1000 rupees. So, 2100 minus 1000, it is 1100. So, just I again repeat the equation, bad debts, the amount of bad debts, that is the amount of bad debts which is provided in the trial balance, which is 0, plus further bad debts. So, further bad debts, this is the amount of bad debts which has been provided in additional information outside the trial balance, which is 600, plus new provision is 1500. So, total is 2100 minus old provision is 1000. Therefore, the net amount is 1100 which is to be debited to the profit and loss account. So, here you can see the equation, existing provision for bad debts, it is rupees 1000, that is the old provision less bad debts. So, when I told you friends that when the old provision has been provided in the trial balance, so any amount of bad debts taking place in the current year will be met out first from the old provision. So, the fresh bad debts which has taken place during the current year, that is rupees 600, will be met out from rupees 1000. So, the net amount is rupees 400. It means the surplus amount of old provision is 400 with us. The provision required at the end of the year is 1500. So, therefore, less surplus of old provision, it is 400. So, amount to be debited to the profit and loss account is 1100. The above aspects will be shown in the debit side of profit and loss account, it is 1100, and as far as the balance sheet is concerned, here it will be shown like this: by provision for bad debts, old provision less bad debts less new provision. In this connection, the learner should note the following point. The first one is, if some bad debts are given in adjustment, that is what we call further bad debts, they should also be taken into account. The new provision should always be calculated after deducting the amount of further bad debts from the amount of debtors. So, only after deducting the amount of further bad debts from the amount of debtor, the new provision must be made. This the learner must always keep in mind. Then the third one is the balance sheet only after further bad debts given in the adjustment. So the net amount which is to be shown in the balance sheet is very clear, that from the amount of debtors which is given in the trial balance, so from that balance two things must be subtracted. The first one is amount of further bad debts which is provided in the provided outside the trial balance, and the amount of new provision. So if we subtract two things, that is the amount of further bad debts and the amount of new provision from the amount of debtors given in the trial balance, so the net amount must be shown in the asset side of the balance sheet. So here an illustration is given that on 31st December 2018 the amount of debtors is given 64,000, bad debts is given 4,000, provision for bad debts 7,000. It means the 7,000 is the old provision. So further bad debts is given rupees 2,000 outside the trial balance, and we have to create a provision for doubtful debts at the rate of 5% on debtors. Show the treatment of bad debts and provision for bad debts in the final account. So it's very clear, friends. First of all, we will deal it in the debit side of profit and loss account. So here we have a very simple equation, and that equation is bad debts. So bad debts is 4,000 plus further bad debts is 2,000 plus new provision. So new provision we have to make on 62,000, as I have made it very clear that the new provision should be made on the amount of debtor after deducting the further amount of further bad debts. So deduct rupees 2,000 from 64,000, so the amount is 62,000. So on this amount 5%, that is 3,100. So the new provision will be 3,100 and the old provision is 7,000. So bad debts 4,000 plus further bad debts 2,000, that is 6,000 plus new provision 3,100. So 6,000 and 3,100, it is 9,100 minus old provision is 7,000. So if 9,100, if we subtract 7,000 rupees out of 9,100, so the remaining amount would be 2,100. So this 2,100 will be subtracted, will be shown in the debit side of profit and loss account. See here, bad debts account. So here, friends, provision for bad debts we have given bad debts 4,000 is given, and then 2,000 again bad debts is given 6,000. So total provision for bad debts is 6,000. Okay. Then the next one is provision for bad and doubtful debts. So here, as I have made it 2,100, so this remaining, the net amount of rupees 2,100 is debited to the profit and loss accounts, because old provision 7,000 is given, that is shown in the credit side here. Credit side 7,000, this is the old provision, and bad debts 6,000 we have already calculated from the previous one, and the balance 3,100 here it is given in the new provision. This is the amount of new provision which we have calculated, because the total amount of debt was 64,000, the amount of further bad debts was 2,000. So the new provision should always be made after subtracting the amount of further bad debts from the amount of the debtor. So the amount of debtor was 64,000, the amount of further bad debts was 2,000. So therefore, when we subtract rupees 2,000 out of 64,000, the amount comes to 62,000. So on 62,000 we should make a provision, we should make a new provision at the rate of 5%, that comes to 3,100. So here this is the balancing figure of rupees 2,100 which must be charged from the profit and loss account. And in the balance sheet the amount of the debtor was 64,000. So out of 64,000, two things should be subtracted: amount of further bad debts and new provision. So amount of further bad debts was 2,000. So net amount is 62,000, and out of 62,000 the new provision must also be subtracted, and new provision is 3,100. Therefore the net amount of debtor would be 58,900, which must be shown in the asset side of the balance sheet, 58,900. So this was all about the lecture on financial statements. I am sure that the students might have been benefited a lot, and the student must be very, very clear while dealing with the provision of bad debts and provision for bad debts simultaneously. Thank you all.